Hi, welcome to the video series for Sea Grant's Integrated Financial Model for Kelp Aquaculture. On this video, I'm going to be talking about the outputs of the model, basically everything here in the lower half of this graphic. So if this is your first time here, I would suggest that you start with the introductory video where I discuss the sort of navigation and conventions of the model and the overview of the model. And I should note that this discussion of the financial outputs of the model is built on the general business model that we used to complete all of these user input sheets in prior videos, but I adjusted the values of the outputs to come up with a profitable operation so we could discuss some of the outputs in a more meaningful way. Okay, so as always, we can either navigate this model by clicking on these hyperlinks or by just navigating directly to the pages. And what I'm going to do, although we're not going to be moving from left to right in this graphic here, what I'm going to do is start with the pro forma P&L, also known as an income statement. And here we are at the 3-year projected income statements for Kelp Me, I Think I'm Falling. Okay, so this is 3 years. This business model is for 3 years, and these income statements are presented by quarter, with the first quarter of the income statement being the sort of the first quarter of what we're considering to be the operating cycle of an integrated kelp farm and nursery operation. Okay. And so we have revenues coming in from both seed string and from kelp. And the structure of an income statement is that revenues are presented first, and then the direct cost or cost of goods sold, which in this case entails hired labor plus consumable. We are not looking at any revenue or costs for non-use activities because I want to discuss just the economics of kelp seed production and wet kelp production. Okay. In a standard income statement, your first subtotal is your gross margin, which is essentially revenues minus the cost of those revenues. And then this gross margin is what allows you to pay for all your overhead or all your operating expenses. Okay. Your operating expenses here are presented as another subtotal, and then we start looking at depreciation and interest expense, which are not directly associated or within control of the operator of this business, and then that gives us our net income before tax. This model does not address tax issues, so this just gives you pre-tax net income or profit. Okay, and so I have adjusted the inputs in this model to provide a positive profit for the operations, so that some of the other economic analysis will make more sense. But this is really the bottom line. That's why they call it the bottom line. Did you make a profit after accounting for all of the expenses associated for running your business, including depreciation, which is essentially spreading out your upfront costs over the usable life of any of your long-term assets such as equipment. Okay. So that's what an income statement is. It tells you whether you make a profit. And this is sort of the most important statistic for your business. Are you making money? Is it profitable? Okay. Now, I will note that your profit reporting in an income statement does not include your own labor. If you recall from when we were entering data, you were prompted to enter an hourly rate that you kind of want to think about paying yourself. But in this particular output sheet, your payment to yourself is not included. That sort of takes us to the next output sheet that I want to look at, which is the cash flow statement. Now, a cash flow statement is laid out in a particular order, beginning with your opening cash balance or your beginning balance each quarter. And then to that, you add any cash inflow that's coming in. In this case, the only cash inflow that we're interested in is sales, right? So here's our revenue from selling seed here in quarter 4 and from selling wet kelp here in quarter 2, right? And then after that, you total up your inflows and then you start taking into consideration all of your cash outflows. Now, accounting principles require that we sort of subdivide cash outflows into 3 different general categories of activities: investing activities, operating activities, and financing activities. Okay, so these are all the things that you would spend cash on. And your operating activities here are plugged in from the remainder of the model. These are coming to this statement from, if you see the cell reference, these are coming directly from the income statement, the pro forma P&L. But here in investing activities, this is where users can account for their planned new fixed asset purchases. Okay, so this is almost like a wish list of what you think you want to get later on in this business. For instance, in our example here, we have a new piece of machinery that we're going to get in the second year of operations. Okay, so these are investing activities that would reduce our cash flow or constitute an outflow of cash, and users can enter data here, as discussed in a prior video, in these boxed areas. Okay, operating activities, as I said, come to us directly from the P&L, and then financing activities would constitute loan payments, which are generated from the funding sheet. And then financing activities also involve any distribution of money to the owner. So this is where you are going to pay yourself out of here. Okay, so right now we don't have this model showing any distribution of cash to the owner. But and you know, in the first quarter of operations, you probably can't afford it because look, even without paying yourself, you are in a negative cash position. But beginning in the second quarter of operations, because you are having positive cash flow from selling that seed string, you start accumulating a cash balance, which can accommodate your quarters of negative cash flow, right? So if you wanted to pay yourself, this is where you would enter that. So let's say you're going to pay yourself a couple $1,000s every quarter. And let's see what, if we do that for every year, let's see what the end result of that is. Okay, so you see how if you say I'm going to pay myself $2,000 a quarter for doing this, at the end of the day, you still wind up with a positive cash balance. And this does not affect your profitability because the owner's draw is separate from the calculation of your business's profit. Okay, so that's the cash flow statement. Now, let's go to the balance sheet, the budgeted balance sheet or pro forma or forward-looking balance sheet, and see how that looks. Now, keeping in mind, right, that there's a relationship between the cash flow statement, the income statement, and the balance sheet. Right, so let's take a look at the balance sheet now. So the balance sheet is sort of a snapshot in time. Right? It tells you what is the value of what you own, your assets. So all of your cash, your equipment, your vehicles, any real estate that you have. So right now we've got a business that has a beginning balance of $64,000 of assets. You have $23,000 in loans that you took out to start this thing. And then the value of the owner's equity, including the value of those things that we brought over in a prior video for the opening balance sheet, right? That equity value is 41,000, which brings us to a total of 64,000 between the loans and what the owner's equity brings in. Okay. In the next year, by the end of the first year, okay, we bring the cash balance at the end of the next year over from the cash flow statement. The value of all of our fixed assets is being drawn down by depreciation. Okay, our loan balances are coming down because we're paying them off. The initial value of our investment doesn't change, but now we are adding to the value of the business through making a profit, and then we reduce the retained earnings by paying ourselves this $6,000, giving a total equity value in the business, or a total net worth of the business, from 41 at the beginning of time to 48 after a year. So that's how a balance sheet works. It connects the operation of the business with the actual standing of the business at the end of the year. So that's the financial outputs. Now we have a couple of additional output sheets that are more on the economics side. And, this isn't meant to be like an economics class, but I do want to show you these enterprise budgets and sensitivity analyses. Okay, so let's look at the enterprise budget first. So the enterprise budget, what that does is it gives you a breakdown of essentially the economics, the cost structure of your business. And you will notice that there is an enterprise budget here for a standalone nursery operation, which is blank because we're not doing a standalone nursery operation. Okay, so this model has like switches that would switch on a standalone nursery operation enterprise budget if that's what we were doing. Likewise with a standalone kelp farm operation. Okay, so here we have an enterprise budget for an integrated operation. And the first thing I want to emphasize, and I can't emphasize it enough, this is not a budget the way that we normally think of a budget, right? When I think of a budget, I think of it as a plan for how much I can afford to spend next month, next year, either as a business or as an individual. Okay, that's not what an enterprise budget is. An enterprise budget is an economic analysis of the cost structure of production. Okay, so this integrated model is assuming that we are producing kelp. Although we're producing seed string along the way, the seed string is just a component part of the production of kelp. And so without going into too much detail, right, we break out variable costs associated with labor and materials, and then determine how much each of those variable costs is per unit of production of kelp. And notably, we also consider owner's labor in here because you have to make an economic profit. It has to be worth your time to do this. Right? So we come up with a total variable cost per unit of wet kelp of 71 cents per unit, right? If we're considering our owner's labor, or 47 cents per unit if we are not, okay? That gives us a margin, what's called a contribution margin, which can be applied to covering fixed costs. And doing this kind of analysis allows us to do break-even analysis and determine what level of production we need to cover the fixed costs. And this break-even analysis is computed both with and without owner's labor. So right now, clearly we are turning a profit, and we have therefore produced beyond what our break-even levels of production are. Okay, so that's just a quick and dirty overview of an enterprise budget. And the last economic analysis output is sensitivity analysis. Now, sensitivity analysis, just like with the enterprise budgets, we do them for a standalone nursery operation, which does not apply here, for a standalone kelp operation, which does not apply here, and then for an integrated operation. Now, these tables, all they do is they tell you, okay, this one over here, it says sensitivity of first year pre-tax profit to changes in variable costs. Right, so here's the profit that we have in this model. Okay, and then what this table does is it kind of takes the cost up. So here, this top row tells us our variable cost per pound of kelp. We start at 0.301. We increase that by 10% across the top, and then cost of seed over here, and we do some calculations and we get to our profit. Now, speaking personally, I don't find sensitivity tables particularly easy to follow or intuitive at all. There is a much cleaner and more detailed way of changing inputs and seeing what the results are in terms of the outputs, which we're going to discuss in one more video, which is about scenario analysis. So I'm going to leave this video here. We're going to call an end to it, and then we can pick up again with some scenario analysis, which will show you in more detail and what I consider to be easier to understand what happens to profit when you change multiple inputs.